All right, let's just wrap up this process. We started with the sales budget. And we can see that we're planning on selling 5,000 in the first quarter and 6,000 in the second quarter. Again, this is a budget, it's a guess, but it's better to have a plan that might be a little flawed than no plan at all. So just remember that you're going to need some wiggle room in your budget. And we did that with the 10% required ending inventory or 20% required inventory. A little bit of wiggle room in case things don't go quite as we planned out. But we start with the sales budget. We always start there and say, how much are we going to sell? Then we move into the production budget. And so we pull the sales numbers from the sales budget into the production budget. So that's how those two flow together. We calculate how much do we need to produce. We take into account how much do we want in our ending inventory and how much did we already have to begin with. And those numbers also flow. Remember, ending inventory from one quarter is the beginning inventory of the next quarter. If you're doing a totals column, the ending inventory is the ending inventory of the last quarter that you're doing. The beginning inventory is the beginning inventory of the first quarter that you're doing. You can double check things on the totals column by if the total column should go down and also across. So both of those should equal the same thing. We can use our production budget to now calculate how much do we need in direct materials, direct labor, and manufacturing overhead. So we'll take how much we're going to produce and translate that into how much do we need in materials. In a very complex manufacturing facility, this is going to be a lot of different direct materials budgets. In this example, we just said a lamp just used metal, but we would probably calculate also how much do we need in light bulbs, or how much do we need in wires to wire up the lamps. So you might have 3, 4, 5, 20 different direct materials budgets to plan out how much do I need to buy in all of the different materials. All right, but again, in this example, we just did one. We said, how much metal does it need? These things flow from the production budget over into the direct materials budget. We have to translate it into pounds of metal or number of light bulbs or maybe length of wire. In this case, it was pounds of metal. So translate it into pounds of metal. Again, we have ending inventory, beginning inventory, and then multiply that by how much it costs for each of those things to get the number of dollars that we're going to be spending. And just like the production budget, the ending inventory for one quarter flows into the beginning inventory of the next one. And the total column also works the same way as the production budget. Direct labor is a little bit easier. We can figure out or make a guess at how much time does it take to produce each of these things from our employees and translate that into how much are we going to be paying our employees to make these lamps. And then we have the manufacturing overhead budget. These are the things that we can't directly trace to something because it could be electricity. It's really hard to say this is how much electricity went into the lamp or this is how much rent went into the lamp. But we do at least separate this into variable overhead, meaning for every lamp that we produce or for every hour we pay our employee, it costs us this much more. In this case, it was $3 per hour that we paid our employees, plus our fixed overhead, which doesn't change. It's always the same, like rent or depreciation. those things don't change. So we just say, all right, we pull out the appropriate number from either the direct materials, the direct labor budget, and say, all right, this is our variable overhead. Let's add in the fixed overhead to that, and that gets us our total manufacturing overhead for each of those quarters. All right, the next step would be, which we're not going to demonstrate on screen because it can be quite an involved calculation, but the next step would be, how much does each of these lamps cost? And what we would do is we would basically take the three numbers that we have here, our direct materials costs, our direct labor cost, and our manufacturing overhead costs, and say, all right, this is how much it cost us to produce each of these lamps. And why do we need to know that number? In accounting, when we make a sale, we have to assign a cost of goods sold to that sale. So when we finally produce the lamps and sell them to a customer, we have to say, this is how much our lamp cost us to make. And in this case, it's $2 per pound of material. Our direct labor costs are going to be $10 per lamp, but then the manufacturing overhead changes things a little bit because it changes based on how many we produced and then the fixed costs. So every lamp is not created equal. Again, I'm not showing this one on screen because it can be a little complex, and I don't really want to get that deep into the weeds on these calculations. So my overall goal is to show you how all of these things flow together and how we can use this to plan out in a business how much we're going to buy and the shifts for our employees that we're going to have to put together.